Good afternoon, everyone. Thanks for joining us. We'll give it just a few minutes here to let folks enter the webinar, and then we'll get started. Well, it looks like our numbers are starting to stabilize, and I want to make sure we take advantage of our hours. So I'll go ahead and do a quick introduction and then turn it over to our speaker for today. But good afternoon, everyone. Thank you so much for joining us for today's Lunch and Learn. I am Louise Bedsworth. I'm the Executive Director of the Center for Law, Energy, and the Environment at Berkeley Law. As many of you know, CLE is a research center within the law school that really is sitting at the boundary to link the expertise and work of the university with policymakers, decision makers, businesses, and others to help solve our most challenging environmental and climate problems. We work with business, government, and the nonprofit sector, often working in interdisciplinary ways, and really trying to draw on the combined expertise of our faculty, staff, and students to bring efficient and effective solutions to large policy problems. Our Lunch and Learn series gives us an opportunity to explore some of our emerging research issues and discuss some of the challenging problems that we're facing, and often being able to present innovative and new findings or solutions. Our Lunch and Learn series is made possible through the generous support of our partners, Wilson Sonsini, Hanson Bridget, and Oric. Today, we are very lucky to be joined by Dave Jones, who is the Climate Risk Initiative, Director of the Climate Risk Initiative here at CLE, to talk through, I think, a really pressing issue that we have been seeing come to the fore over and over again over the last few years, and certainly just even over the last few days, weeks, and months of this year. And that is how climate change is affecting the insurance market and insurance regulation. And really the broad question is, are we headed towards an uninsurable world when we're looking at the types of impacts and risks that we're seeing being enhanced and or caused by changing climate? So many of you probably know Dave because he's been working in this space for quite some time, but I'll do a quick introduction. As I said, Dave directs the Climate Risk Initiative here at CLE and has also worked at the Nature Conservancy and was a distinguished fellow with the Climate Works Foundation. But particularly important for this conversation, Dave served as the California's Insurance Commissioner from 2011 to 2018 and founded and chaired the Sustainable Insurance Forum, which is an international network of insurance regulators developing climate risk regulation best practices. He was the first U.S. financial regulator to require disclosure of investments in fossil fuel assets driven by concerns around climate change, and the first to conduct climate risk scenario analysis of insurers' investment portfolios. He's testified before Congress, state legislatures, the G20 Financial Stability Board, and numerous other regulatory agencies about the need for financial regulators to address climate change and the risks that it's posing to our financial system. He is not, unfortunately, a graduate of Berkeley Law, but does have a JD and MPP from Harvard. But we still let him hang out with us here at Berkeley, and we're thrilled to have him here. So I think Dave is going to kick us off, providing an overview of sort of the state of what's happening in the insurance market. And then we will open it up. I have some questions, but want to really engage all of you in the audience to ask questions as well. And we were talking right before this, of course, we're looking at this through the lens of insurance and markets. And I think we all have to acknowledge that at the heart of all of this are people and communities and lives and health and many very personal impacts. And so want to be keeping that in mind, certainly, especially given the devastation that we've seen on Maui over the last few days. And so just want to keep that in mind as we're diving into this conversation as well. So thank you all for joining us. I'll turn it over to Dave.
Great. Thanks a lot for that introduction, and very excited to be here. And thanks for all of you who are tuning in. I thought I would begin by just, using California as a bit of an example of how climate-driven weather-related events and catastrophes are landing in various geographies throughout the United States and globally and causing death and injury, but also significant disruption in insurance markets. This story that one can tell in California is also being written in Florida and Louisiana and Texas with regard to wind risk and hurricanes, in parts of the rest of the Western United States with regard to wildfires, and along the Northeast and Southeast coast with regard to wind. There really is almost no geography in the United States that's not been impacted or won't be impacted in some way by climate change, physical impacts from climate change, and related insurance market impacts. Vermont, which was long thought to be a terrific refuge from climate impacts, when we saw horrible flooding there very recently, loss of life, injury, and loss of property, and now the terrible, terrible events in Hawaii. So a quick picture in California. The insured wildfire-related losses between 2015 and 2021 are about $48 billion. California has been home to 8 of the largest wildfires in terms of loss in the last 7 or 8 years. We continue to be on track, sadly, although we've had a bit of a respite, to see drier conditions, changes in how precipitation falls, and more losses with regard to wildfire. The way that's impacting insurance markets is not really a surprise, and this has been going on for some time. Insurance companies are rational economic actors. When they experience significant losses, they respond by raising price and by reducing those losses by either excluding coverage for the perils that are driving the losses, or in some cases, not renewing insurance for particular properties that face growing risk related to climate change, in this case, wildfire, and also not writing new insurance. And so what this chart shows, which is from the California Department of Insurance, is just the increase in both insurer-initiated and consumer-initiated non-renewals. Remember, home insurance contracts are one-year contracts. You have no right to have a renewal, although most people have an expectation that their policy will be renewed. And what's happened over time as insurers are facing increasing losses is that they're increasing price as well as not renewing particular homes and particular geographies that are facing higher risk of wildfire. That's areas principally the wildfire urban interface area, which is the area in the foothills and the mountainous regions, but also the coasts of California as well. I note here that the department has broken out consumer-initiated non-renewals. These are oftentimes as a result of price. A consumer decides that they simply can't afford the insurance, and so they don't renew with their particular carrier. They hunt around for other cheaper insurance, or maybe turnover, people selling their homes, people moving out of properties. But it is both are going up significantly. This is an eye chart, but basically what this shows, if you look at the second column between 2015 and 2021, there has been an increase in new home insurance policies written. The third column, there has been an increase over time in renewals, but correspondingly, there's been an increase in consumer-initiated non-renewals as well as insurance company non-renewals. And what's most significant is the FAIR Plan, which is the state statutorily created insurer, fire insurer of last resort. It's basically an involuntary association of insurers. Any home insurer that's licensed to write home insurance in the state is by state statute a participant in the FAIR Plan. The FAIR Plan functions as an insurer, writes a fire insurance policy for any homeowner, condominium owner, or renter in some small businesses within the state. What's happened is that their policy issuance has risen dramatically between 2015 and 2021. The last set of columns is what's called the surplus lines market. That's the market of less regulated insurers, think Lloyd's of London and others, that homeowners will oftentimes turn to if they can't find insurance from an admitted carrier, a AAA, a State Farm, an Allstate, or Geico, or they can't afford the FAIR Plan, they might try to look for insurance with the surplus lines market. Those numbers have been growing as well. So to illustrate this graphically, you can see here that the FAIR Plan total policy count has increased dramatically between 2015 and 2021 on a percentage basis. A very, very significant increase. And that's because people are not being renewed by their private home insurer. And so they're forced to buy a policy from the FAIR Plan. The FAIR Plan policies by law are priced based on risk. There's not a subsidy involved by the general fund or the taxpayers of California. And since the FAIR Plan is insuring those homes that the direct insurers have concluded are the riskiest and have declined to insure, you find a policy universe of policyholders that the FAIR Plan has of the riskiest homes, and they have to set price accordingly. So the FAIR Plan policies are very expensive. People oftentimes complain about that, but that's because the price is based on the risk. And we see that policy count growing, and we can anticipate that policy count is going to continue to grow with the news that State Farm is not writing new insurance, Farmers is not writing new insurance, Allstate is not writing new insurance in the state of California. And then also other insurers are continuing on a home by home basis, business by business basis, condominium by condominium basis, deciding that as they apply underwriting models that look at the risk, that those homes, those condominiums, those tenants living in places that are too risky, and so they won't write and they won't renew. So this trajectory is only going to get worse over time as climate change continues to drive wildfire losses. Now, to keep this in perspective, however, although the year-over-year increase of FAIR Plan policies from 2015 to 2021 has been dramatic, the FAIR Plan only represents about 3% of the market. So it is true that for folks that have to buy the FAIR Plan because they can't get their insurance renewed from their private direct writing admitted carrier, it is expensive. They're not happy about this. In some cases, some of these homeowners may not be able to afford the FAIR Plan, and so then go without insurance. But so far, as a percentage of the market, it's about 3 to 4%. That's going to increase, though, as we continue to see climate change accelerate due to our failure to reduce greenhouse gas emissions fast enough and comprehensively enough in order to reduce temperature rise, which is one of the main drivers of climate change and wildfire loss in California. Where this lands, though, is very different. And so what this little chart illustrates is that essentially it's those homeowners in those counties with the highest exposure to fire risk where the largest percentage of FAIR Plan policies are being written. And so this is an issue that's, again, most acute in the wildland urban interface areas and in those counties that have lands in those areas. A substantial percentage of the policies in those areas are written by the FAIR Plan, and we can expect that that is only going to continue as well. So this is a bit of an eye chart, but one thing that it's important to pay attention to is what's called the loss ratio, which is the percentage of the premium collected in a given year that's paid out in losses. And if you look at the second row, the homeowners insurance line, there was about $10.9 billion in written premium. The loss ratio was 46.15%. So 46.15% of that was paid out in losses, slightly higher in 2022. In 2017 and 2018, however, when we had about $12 and $15 billion in insured losses respectively, the loss ratios in the homeowners market in California exceeded 100%. That means basically they're paying out more than 100% of what they've collected, and the company certainly made no profits that year. It's also important too to look at what's called the combined ratio, which is not just the loss ratio, which are the blue lines here in this eye chart, but also what's called the loss adjustment expense, which is the percentage of costs the insurer has in acquiring the policyholder, as well as the expenses associated with administering claims too. And so this is from S&P Global Market Intelligence, but this shows last year that the largest insurers had combined ratios over 100% or close to it, which means that they're paying more than 100% in losses, but also to cover their expenses associated with those losses. So I'm going to stop there. That picture can be told also with regard to other perils in Florida, Louisiana, where we've had a substantial number of insurers actually become insolvent, where their version of the FAIR plan is grown dramatically in terms of market share for wind risk and homeowners insurance generally. Texas, same story. And you see this in other geographies too. So that's the challenge we face.
Great. Well, thank you so much, Dave. And I want to encourage everyone to put questions that you have into the question and answer box, and we will go through those. But maybe as you've painted the challenge and the scale of the problem we're facing, what do you see as the priority solutions for addressing this? And I know you've mentioned different states have done this differently. And so what do we need to be doing to start getting out ahead of this problem?
So fundamentally, what's driving insured losses in different geographies and states around the United States is climate change, which in turn is driven by greenhouse gas emissions, which sadly are only continuing to rise despite best efforts by California and a handful of other states, and more recently the federal government. So fundamentally, we need to dramatically, substantially, and comprehensively reduce greenhouse gas emissions. Because without that, some of the other things I'm going to talk about in a moment, which are important and will have some benefit, are ultimately going to be overwhelmed by the increase in global temperature, and then climate change driven catastrophic events like those that we're seeing with greater severity and frequency here in the United States and across the globe. Now, one thing that insurers can do to participate in that is to stop insuring fossil fuel infrastructure. Insurers do write insurance, and it may not be the same insurers that are writing home insurance and auto insurance, but within the house of insurance, there are insurers, including some of the same insurers that write insurance for fossil fuel infrastructure. And one contribution insurers could make would be to cease that activity so that fossil fuel infrastructure has to bear more of the cost, if you will, of their operations, which ultimately are contributing to climate change and insured losses in the home insurance market and other markets in California. The second thing would be to stop investing in the fossil fuel industry as well. There's some insurers globally and in the United States that have made a commitment not to invest their reserves or capital in coal, in tar sands, but expanding that to include other aspects of the fossil fuel infrastructure would be a way insurers could contribute to trying to reduce greenhouse gas emissions. But fundamentally, and California's been a leader in this. We're, I think, 1 year from the passage of the Inflation Reduction Act, which has a tremendous amount of resources to help us move from fossil fuel-based energy systems to clean energy and renewable energy. But we just need to move faster because what's happening is the climate is changing around us, and it's causing loss of life, injury, loss of property, and insured losses. A second category of things we can do is invest more in mitigation and adaptation. And in the wildfire context, there's a empirically proven approach, which is a nature-based approach that involves what's called ecological forest management, which involves thinning of forests, not clear cutting, and using prescribed fire in the way that nature used prescribed fire before we began about 150 years of fire suppression in all of our western forests. And doing this more aggressively in California and other parts of the western United States that face wildfire risk can make a big difference in reducing the severity of wildfire. California has appropriated some $2 to $3 billion to engage in more forest management, which is terrific. The infrastructure bill that was passed under the Biden administration, early in the administration, has about $5 or $6 billion for federal lands nationally to try to do more management of those lands to reduce wildfire risk. Some of that money will land in California. That's terrific. But the Nature Conservancy did a study about a year and a half ago that said that we need about $5 to $6 billion annually for 10 years to really knock down the wildfire risk that exists on federal lands across the United States, including in California. So more investment in forest management. The state set a laudatory goal of 1 million acres of forest management in California the other year. There was a report in 2021 that said we'd only done 200,000 acres that year. So we've really got to ramp up that activity. One way to do that, there's an insurance element here too, is it turns out that at some point the insurers realized about 5 or 6 years ago that they were insuring the people that actually light fires in the forest. And so you can imagine how those conversations went. And so basically they stopped insuring prescribed burners. So the solution that we came up with was to create a prescribed fire claims fund, which we just stood up in CAL FIRE, which will be a substitute for insurance that will be available for prescribed burners to point to. So then when they go on lands and the landowner says, wait, you don't have insurance, there'll be access to this claims fund in case the prescribed fire, in the very, very limited cases in which it does, something like 0.02% of prescribed burns nationally escape. But insurers decided they didn't want to insure it. And so we've created a workaround for that here in the state of California. There's an opportunity to take that nationally. I guess the third set of solutions are and there's a debate about these. There's a set of solutions the insurers are proposing. One is that they be allowed to include in California their reinsurance costs. Consumer groups and staff at the Department of Insurance have historically opposed this because they argue that when rates are being set for home insurers, they get to count the losses that the reinsurers are covering. And so from the standpoint of consumer groups and historically the staff at the department, it would be double counting to include those reinsurance costs. Many states do allow the inclusion of reinsurance costs in ratings. So that's one argument the insurers are making, which is, hey, allow us to include that. We'll be able to increase our rates. We'll write more insurance. The second argument they're making is that they should be allowed to use what are called probabilistic forward-looking climate models to set rates. The department and consumer groups have historically opposed that because they're concerned about these models being black boxes, not being able to completely understand how they operate. They also argue that our current system of experience rating, which heavily weights recent experience in setting rates, has worked well. And with one exception, we haven't seen any insurance companies go insolvent. So there's a huge debate about that, but that's a set of policy solutions that are being considered right now by the Department of Insurance and the legislature. I guess the fourth thing is the FAIR Plan itself. I think we're going to have to continue to raise the coverage limits in the FAIR Plan. The commissioner did this the other month. And so that has made the FAIR Plan more available to those that have higher value properties. But there's a particular issue right now that developers of multifamily and condominiums are facing, which is that the FAIR Plan coverage limits for those kinds of structures have been raised to about $20 million, but it's $20 million per location. And a condominium builder that's building, maybe 10, 20, 30, 40, 50 units at a particular location is going to quickly have a value for that structure that will exceed the FAIR Plan coverage of 20 million. And so the California Building Industry Association testified in a department hearing the other month that right now this is a big problem for developers of multifamily housing, which is the kind of housing we want to see more of: high density, reduced vehicle miles traveled, hopefully, within access to transit. Harder to build that sort of housing, particularly in areas facing wildfire risk because of the FAIR Plan coverage limit. I think the other thing we're going to need to think about too is there are distributional consequences of the FAIR Plan. It's very expensive. We're going to see more people have to resort to it. And so for seniors on fixed incomes or other low-income families that own housing, I think what we need to consider is something similar to what we've done under the Affordable Care Act with the California Health Benefits Exchange and other exchanges, where the price of the health insurance is not suppressed, but lower income families and individuals get a premium subsidy. And you could do a similar thing with regard to lower income individuals who are having to buy FAIR Plan policies. I guess another category is improving the underwriting models that insurers are using. Insurers are increasingly using models to decide whether to renew or write insurance. Those models, in many cases, are not terribly sophisticated, and they don't take into account the benefits of landscape scale forest management of the type that California federally is occurring, and some localities and tribes are doing as well. And so improving those underwriting models so that they actually account for the benefits of ecological forest management at a landscape scale, I think is important, because then entities that are doing that work will see some benefit, ideally, in terms of availability of insurance, and also improving those underwriting models to take into account home hardening to the extent they don't, and community-based mitigation through vehicles like Firewise councils, I think is another critically important aspect of the solution set. So those are some of the solutions and some of the debates that are occurring right now in real time about the solutions. But let me just go back to the first one, which is reducing greenhouse gas emissions. I mean, we are, I believe, marching towards an uninsurable future if we don't more aggressively reduce greenhouse gas emissions, because these other things that I've described can be helpful in various ways, shapes and forms, but without getting at what's driving the risk underneath and what's driving the losses, I believe that the benefits of other sorts of approaches are going to ultimately be overwhelmed by the risk and the loss that's being driven by increasing temperatures and climate change.
Great. Well, thank you. And I think we have a lot of questions that have come in that probably dig in on some of the things you just talked through. Maybe I'll start with maybe the easiest question, which was actually someone who's very impressed with the data and the information you presented. Could you where did the 48 billion insured loss number, is that from the state?
Basically what I took was a chart of insured losses that I think I found it on either the NAIC website or the Insurance Information Institute website, or maybe the Department of Insurance website. I should have added the citation. I put the slides together very quickly. But I just added up roughly the insured losses over that period of time. It may be off by $1 billion.
Great. Well, one thing you touched on was the ability to recover reinsurance costs in rates. Can you talk a little bit about what's happening in the reinsurance market right now?
Certainly. So reinsurers, for those for whom this subject is new, are insurers who insure insurance companies, basically. So they are typically global in reach. And what they do is they will essentially provide insurance for an insurance company and take on some of the risks that the insurance company is writing, and agree that at a certain point in losses that the underlying insurance company might reach, that the reinsurance will kick in to cover losses above whatever that point is. Not surprisingly, because reinsurers are seeing global insured losses increase due to climate change, whether it's losses due to hurricanes and wind or wildfires in the United States or other parts of the geography, or other climate-driven losses like flooding. The price of reinsurance is going up, and that is an additional cost factor for insurers. And insurers are arguing in the United States that, and particularly in California, they ought to be able to include their reinsurance costs in the pricing. Now, this is allowed in many other states. California so far has chosen not to do it because there's a concern historically that reinsurance is unregulated. And so there's no regulation of the pricing of reinsurance. So there's a concern that reinsurance prices may not be entirely justifiable. That's the argument. There's a concern also, as I said a moment ago, that because when California sets rates or approves rates for direct home insurance writers, they will look at the losses that the insurance company incurred, but also the losses paid by the reinsurer, and give credit in setting the new rate to losses that were paid for by the reinsurer. So the argument has been by department staff as well as consumer groups is that it would be double counting to both give credit for the losses that are covered by reinsurance and also include the reinsurance costs. So that's the nature of that debate. The other big debate is about these forward-looking probabilistic models. Insurance companies in California argue, yes, climate change is happening. It's no longer occurring in a linear fashion. We ought to be able to use probabilistic models that can help us assess more probabilistically what the losses might be from wildfire and other perils, and use those to set rates. They are allowed to use probabilistic models to set rate relativities between classes of, say, homes that they're insuring, but they're not allowed to use them to basically set the overall underlying rate. The argument by the consumer groups in the department has been severalfold against this. One is, we're very concerned that these are black boxes. Insurers are not willing to share the black boxes with the consumer groups. There's concern about the department being able to understand the black boxes, given limits on its ability to hire the most expensive expertise because of a civil service compensation system. There's concern about potential proxy discrimination in these black box models that use AI and may result in discrimination against certain protected classes by seizing on particular characteristics or behaviors which correlate with risk, but also correlate with particular races, ethnicities, national origins, religions, gender, et cetera. And then the final argument of the consumer groups and the staff is that while not perfect, experience-based rating has worked well enough that insurers have been charging rates sufficient to cover their losses. Yes, in some years they did not make a profit, but there's no guarantee that they're going to make a profit. And the argument is also, if you look to states like Florida and Louisiana that have allowed probabilistic models for rating, that allow reinsurance costs to be included in rates, that as states have done a number of other things to reduce cost to insurers, you still see in those states, and admittedly, a different risks, so you got to be careful about apples to oranges comparison, but in those states at least, the risk of wind is so high that there's apparently no price at which direct writers are going to be willing to write that risk, and they're declining to write wind risk in Florida and Louisiana, and so more people are being thrown onto the FAIR plans there. So that's the nature of the argument. The insurer's argument is, look, if you let us use these models, we'll write more insurance. The arguments of the consumer groups and department staff historically has been, well, not so fast, and also where's the guarantee that you'll write more insurance? And so that's been the back and forth with regard to that. And that debate is occurring in real time right now. The commissioner had a hearing about a month ago on the question of whether and to what extent, if these models were to be used in rate setting, to what extent would they have to be made publicly available? Because Proposition 103, which is the state enacted rate regulatory regime in California, voter approved, requires transparency, and that anything that the insurers are using to come up with their rates needs to be made available to consumers. And the insurers are saying, wait, these are proprietary. We put a lot of IP into this. We license these things. We don't want to make them public. So one proposal that came out of one of the consumer groups was to create a state wildfire model that would be publicly available, that would be probabilistic. There's some precedent for this. Florida has done this with regard to wind risk to try to model that risk for its wind FAIR plan. So that's one solution that's being offered. Insurers are arguing, well, what we could do is we could let you have access to the data sets that we're using and some of the factors, but we don't want to release the models themselves because we invest a lot of money in the models. So that's the debate that's occurring right now.
Then that actually builds on a question that we have here. So it seems like there's still need to negotiate how and if we were to incorporate those models, how it could be done in a way that was open and transparent. What do you think the impact would be of starting to use models like that? And maybe it's looking at Florida to say not much would change. I mean, what do you think?
I think it remains to be seen. I mean, I think that there are states many states allow the use of those models. And in Florida, for example, rates are about 3 times the national average. California ranks more towards the bottom in terms of rates because we have this rate approval system. The insurers argue it's not giving them enough rate. So I think using these models may provide a path for some insurers to get more rate and to stay in, but it also might provide a path to have occur a bunch of the issues that the department staff and consumers have traditionally been worried about too. I think there's another aspect to this though too, which is that there's really 2 sets of models, although they're related. There's modeling and figuring out what the rate ought to be for policyholders for a given insurer. But then there's modeling to decide whether to renew or write the insurance in the first place, underwriting modeling. And the models that the insurers are using on the underwriting side, while they are getting more sophisticated and taking advantage of some improved modeling with regard to climate risk, in many respects, they're still very unsophisticated. So, for example, those models, by and large, with one or two exceptions, don't take into account landscape scale forest management, which is a proven, empirically proven way to reduce severe wildfire risk, and in which we're putting a lot of federal and state and local money and tribal money, and we're going to have to do more of. And so those underwriting models ought to be revised to take that into account. They ought to take into account home hardening. If they're not, they ought to take into account community hardening as well. Right now, the underwriting models are completely unregulated, and they don't have to be filed with the Department of Insurance. So I think one question that can be asked is, if we're going to go down the road of using forward-looking probabilistic models on rating, what about the underwriting models? Shouldn't those be transparent? Shouldn't those be improved to take into account the things that fire officials are telling homeowners to do, the things that are the investments that the federal government, the state, local governments, tribes are making in forest management? And shouldn't maybe those two things be linked in some way? So that's one potential policy solution here, which is if this is going to be allowed on the rating side, shouldn't the underwriting modeling side, the issues there be addressed as well?
Great. So now here's a big picture question, which is, do you have any idea how high market insurance rates would have to be to fully incorporate projected future risk?
No,
No.
I don't have a number.
Okay.
I don't have a number, but I think it's a great question, and I think what the insurers are arguing is that under the existing rating system, they're not incorporating the future risk. What the department staff and consumer groups argue is, well, yes, you are, because although the current rating system, you look back 20 years, is a heavy weight with regard to the last couple of years, and yes, losses have been high in the last couple of years, and there's a catastrophe load that gets added to that factors in these catastrophes, and so that's the nature of the debate that's occurring right now. I think it is important to note that insurers have been going in and seeking rate increases. They have gotten just about every rate increase they've sought. They argue that they're constrained in those rate increases, though, because if they seek a rate increase above 7%, they have to go through a public hearing process that, from their perspective, is costly and time consuming. From the consumer's perspective, it's necessary because you can often find things out in a transparent process that you don't find out otherwise. So that's a part of the debate too. But we also may be approaching a point where, for certain perils in certain geographies, there may be no price at which an insurer rationally would write insurance. And I know that sounds extreme, and of course, I guess if people were willing to pay whatever price was charged, or could pay whatever price was charged, I mean, maybe that statement is false, but there may be no price at which people can afford that is sufficient to cover the risk. And we may very well be at that place with regard to wind risk in Florida and Louisiana, right, where the Florida legislature has done a lot of things to try to improve the economic circumstances of insurers. I mean, they allow reinsurance pricing to be included. They allow the use of probabilistic forward-looking models. They placed significant limits on third-party lawsuits, which was an issue in Florida. They created a reinsurance facility that is taxpayer-backed, that sort of suffices to be public reinsurance for direct writers, so that may help reduce or create some competition with the private insurers. All of these things, rates are 3 times the national average for homeowners insurance in Florida. And yet, Farmers the other month announced that not only were they not going to write home insurance on the coast in Florida, but they're not writing any home insurance in Florida. They're not writing auto insurance. They're writing umbrella coverage. So in some geographies, for some climate-driven perils and risks, we may reach a point where realistically there's no price high enough that can actually be afforded by people that would make sense for an insurer to cover that risk. And we have an experience with that with flood insurance. And some 50 or 60 years ago, home insurers decided it doesn't make sense to cover flood insurance. And so they just excluded flood insurance from their home insurance policy. So then the National Flood Insurance Program was created to cover that risk. All sorts of problems there. That would be a whole lunch and learn in and of itself. but we do have some examples, and increasingly examples, and I think that's where things are going to move over time if we don't knock down greenhouse gas emissions that are driving climate change. In certain geographies for certain risks, there may not be any price that people can afford that will allow private insurers to keep writing.
Great.
Well, not so great, but
not so great. Well, and that actually, you answered really a question when someone asked, what do we do if the market collapses overall? And it sounds like we have some models in flood insurance and others of where we're headed.
We have some good models and some bad models.
Yes.
I mean, I would argue the National Flood Insurance Program is a bad model because when it was set up, it wasn't required to be priced based on risk. And every 10 years, Congress tries to require it to be priced based on risk, and people scream about their flood insurance going up, and then Congress backs down. We're on like the third iteration of that. And every 5 or 6 years, Congress has to throw, 15 or $20 billion into the flood insurance program because it's undercapitalized. That's not a great example. Fair Plan in California, I think, a better example. It has to be set, the price has to be set based on risk. I think that sends an appropriate signal to markets, to families, to individuals about what the risk is. It has to be written wherever you are. There are distributional consequences. There are coverage limits that are a problem. One solution also, there's been a concern that direct writers have with regard to the adequate capitalization of the Fair Plan, because if the Fair Plan doesn't have enough money to pay claims, then they surcharge direct writers. So when direct writers are thinking about their losses, it's not only insurance they're writing, but it's if the Fair Plan blows through the amount of reserves it has, and direct writers are proportionally on the hook. So one idea is to do what Louisiana's done, which is to give Fair Plan the ability to issue bonds, and then it could pay off the debt service on those bonds to cover extreme losses over time by surcharging insurers instead of a surcharge, in year 2 after its big losses, which would then be passed on to consumers and have all sorts of disruptive effects too. So I think there are 33 states that have some form of these fair plans. I think spending more time in making sure that those work and work well would be time well spent. At the same time, doing everything we can to try to keep private insurers in the market. I mean, it's critically important we have private insurance. It's a hugely important financial implement. And so doing everything we can to keep them in, but also recognizing that if we're not doing enough to knock down the background risk, if we're not doing enough in the case of, say, wildfire to mitigate with forest management, then we are going to have to look at Fair Plan and Fair Plan-like institutions to try to provide coverage, to make sure coverage is available for people.
So one question that came up here on the fair plans is, are fair plans subject, and maybe this is different across states, but are they subject to rate increase reviews? And sort of how does that work? And if that is, are they allowed sort of to, and you mentioned they are priced according to risk, does that ultimately price out low income households? And sort of, how do we address that challenge?
Yeah, so that's a terrific question. So I believe most, if not all, fair plans, or what are called residual markets in insurance parlance, are required by state law to price based on risk, and they are subject to whatever that state's rate approval system is. So the fair plan has to go into the California Department of Insurance under Proposition 103 to get rate increases. It just got one. I think it was an average 15% increase. It had filed for that rate increase, I believe, 2 years ago. So that's a problem. I recognize why the Commissioner Department are concerned about hitting fair plan policyholders with a rate increase, but if that rate increase is justifiable, it is concerning that it took that long, because that has implications then for the fair plan to be able to pay future claims in the event of a catastrophic event that hits its policyholders. Yes, there are distributional consequences of fair plans, and they fall hardest on those on fixed incomes and low incomes. So one solution set, I believe, would be not to suppress the rate of the fair plan, because I think that's the route the National Flood Insurance Program went. And so what happens there is, if you suppress the price, it sends the wrong signal, and people continue to build more and more in areas of high risk. We've seen that with regard to homes being developed in areas of great flood risk, because people can get, relatively underscore, at least not actuarially rated flood insurance. So you don't want to do that with a fair plan. You want to suppress price, but you could have a premium subsidy that's made available to low-income individuals, much as we have with the Affordable Care Act, where those that are buying health insurance in the California Health Benefits Exchange get a premium subsidy. you don't suppress the health insurance price or the HMO price. So you're still sending a signal as to what the actual cost is of wildfire risk in this context, but you provide a premium subsidy. So that could be something the state could do through its general fund. I would argue that you wouldn't want to make that available for new homes being built in high-risk areas, because that's probably not a good thing to encourage. But for existing homeowners and families that are in areas that are pushed to the FAIR Plan, have fixed incomes, low incomes, a premium subsidy would be one policy solution to make sure that they can continue to afford insurance.
A couple of questions here that have, if you have seen how the banks in the mortgage industry has been dealing with what's happening in the insurance industry. Do you have any insights or observations on that dynamic?
So we're starting to see evidence in various geographies across the United States that climate-driven losses are having an impact on real estate prices. It's maybe taken a little bit longer than one would think should be the case rationally, economically, but you are starting to see home prices, condominium prices in high-risk areas reflect the risk. Part of that may also be a reflection of the challenge of getting insurance, right? So if you're in a high wildfire risk area in California and you have a big problem getting insurance, and you're trying to sell your home or your condominium, I mean, that's a question the buyer is going to ask. And they're going to ask, what's that going to cost? And what's it going to cost if I have to go to the FAIR Plan? And gee, I might have been willing to offer you more money for your home or condominium, but for that, now I'm going to offer you less. So we're starting to see some implications of that. I think more broadly speaking, there is a risk channel there that we ought to all be worried about, because to get a mortgage in this country, you have to have home insurance. If you can't get home insurance because of the risk, you're not going to be able to get a mortgage. Those that have mortgages are supposed to keep home insurance. If they can't get home insurance or they can't afford it, then oftentimes the mortgage lender will have a provision that they can place insurance for them, for the homeowner that has the mortgage. That oftentimes costs a lot more than the insurance they buy on the market. That has implications then for homeowners' ability to begin to continue to pay debt service on their mortgage, which can have implications then for the book of mortgages that a lender might have, or as in the case of most mortgage lenders, they lay those off in the secondary market to Fannie Mae and Freddie Mac. And so to the extent that a large volume of those mortgages in the secondary market are in areas that face high climate change risk, there are impacts potentially on the ability of those mortgage holders to pay their mortgages, to get insurance. Their insurance costs could go up because they can't get insurance, so the bank makes them get the bank's insurance. So that has implications for the ability to service those mortgages. So that can have a potential ripple effect into the secondary market as well. That really bears watching, and that's why another body of work that we're doing at CLE is encouraging financial regulators of banks, insurance companies, pension funds, you name it, to be thinking about these market risks associated with climate change and how they may pass through various markets and have impacts on financial institutions and financial markets writ large. And that could be a whole separate lunch and learn, but there's a body of work that has been led by European and Asian bank and insurance regulators around scenario analysis and stress testing of insurance company and bank portfolios to see how well they withstand losses driven by climate change, to see how well their investments withstand losses. It's really early days in the United States. California, New York, Connecticut have done some pioneering work in this area, which is terrific. We need to see more state insurance regulators across the United States pick up these tools. But we even need to see those three leading states move to the next level, which is climate risk stress testing, where you're actually stress testing the investment portfolios of an insurance company, or if you're a bank regulator, a bank, against various climate scenarios and how well they can withstand them. And then that has implications for how much capital the regulator should require the bank or the insurance company to hold. And the Federal Reserve, the Office of Comptroller of Currency, the credit union regulator, in various ways in this country are beginning to move down that line, although not fast enough. And then you have the SEC, which is doing a rulemaking for publicly traded companies to disclose risks as well. That'll also be an important improvement too. But financial regulation in the United States is really lagging behind our European and Asian brothers and sisters as it relates to climate change.
To what extent do you see governmental units, whether that's local or state or federal government, essentially becoming the default insurer, either directly via inverse condemnation or indirectly through the increased costs of providing shelter and other care costs for those who are most impacted by climate-driven events?
That's a terrific question. I mean, I think that there is help oftentimes, provided by local or state resources to help communities get back on their feet. And then FEMA, of course, helps local communities as well. But those three sources, local, state, and federal under FEMA, provide very limited assistance other than emergency assistance to individuals and families and businesses. A lot of their efforts are directed at the public sector, so helping the community rebuild its water and sewer system and its road system and other infrastructure. I mean, FEMA, for example, in the case of a wildfire that burns people out of their homes, I mean, you can make a claim to FEMA. They'll provide maybe between $5,000 or $10,000 to a homeowner or a family, but that's about it. And it's for emergency services. So I think that's going to continue to be, by and large, the way I think that these sorts of things are addressed. But as people don't have recourse to insurance, then you may see more local, state, and federal efforts to sort of stand in for that. But I think it's more likely what you're going to see is fair plans, increasing what they'll cover because the nature of the perils are changing and they're landing in different geographies across the United States. I think that's probably the way we're going to go, because I think most local governments, state governments, and even the federal government are very hesitant about putting their entire general funds at risk to cover ongoing financial recovery of individuals and homes. I mean, that's really been the history so far. Unless things get really, really bad, I'm not sure that's going to change. I think you're going to see more state insurance like vehicles like FAIR plans stood up to address these sort of things. And I think because the federal government has such a lousy experience with the National Flood Insurance Program, I think there are oftentimes calls for a national wildfire program or a national wind program. There seems to be very little appetite in Congress, whether it's led by Democrats or Republicans, to do that. Bills get introduced, they go nowhere, precisely because the exposure that the federal government would have and the costs are so enormous.
So we have a lot more questions, and I realize we only have about 5 more minutes. So maybe I'll ask you a few quick questions and we can try to see if we can address.
I'll try to give quicker answers.
No, I mean, I think there's so much to talk about here, so it's terrific. One question that came up in a couple of places is if you're seeing any connection between climate litigation, and I think we had the decision in Montana yesterday, of course, and the insurance industry. Are you seeing much interaction or any sort of lessons we can draw there?
So, I mean, there's been a huge increase in volume of lawsuits filed against entities that are significantly responsible for greenhouse gas emissions. So far in this country, those cases are in various, stages of litigation, but there hasn't been, I don't believe in the United States, a successful case of holding a greenhouse gas emitter responsible for the downstream consequences of those emissions. However, you could see the law evolve in that way, potentially. I mean, if you kind of harken back to asbestos or tobacco, I mean, when those products were first on the market, nobody thought anybody could sue anybody about them. And then guess what happened? So the insurance aspect of this is directors and officers insurance, which is something that boards and senior managers of companies will want to make sure their company has. And so that's an area where you're starting to see offers of that insurance begin to consider exclusions for potential losses that a company might face because it's sued by a litigant who says, wait a minute, my community has been burned down and you contributed to that, and attribution science is getting better, and we can now kind of link that directly to you, major fossil fuel producer or some portion of it. And so I'm suing all of you. And so that could include the directors and officers. Did they know? What didn't they know? What did they hide? What steps did they actually take to try to mitigate the risk of that loss? And so there's some evidence that directors and officers insurance is becoming more expensive, and that insurers are considering excluding these sorts of risks because they're concerned about the potential for these lawsuits to finally land in a way that imposes some sort of payout or damages on a company. So that's one aspect in which you're seeing this currently.
So I'll ask one more question, and so you can also sort of give us some thoughts on sort of where we're headed, which is essentially, I know in the long term, and if we think globally, reducing greenhouse gas emissions is the actual solution to this problem, is actually addressing that problem at its core. What are the near-term actions that California, the legislature, maybe, or the insurance commissioner could be taking to try to stabilize this issue, to bring insurers back into California and sort of build a market that is protective and fair?
So we've already talked about a lot of them, but I'll go back to the FAIR Plan, making sure that the FAIR Plan is structured in a way and has recourse to capital in a way that it can cover claims as its policyholder count is getting bigger, raising coverage limits at the FAIR Plan so that multifamily developers and condo developers can have access to the FAIR Plan where they can't find private insurance, because we don't want to choke off that form of development. A premium subsidy for those on the FAIR Plan. I think one exciting development is there is at least one insurer that's developed a model that does take into account forest management and is beginning to look at writing insurance for those on the FAIR Plan. I think that goes to this issue of the underwriting models, making sure that the underwriting models actually account for mitigation, whether it's home hardening, community mitigation, or forest management at a landscape scale, because that's a path for insurers to stay in the market. And there was a paper that I authored jointly with others when I was at the Nature Conservancy that demonstrated that you can account for, on the underwriting modeling, landscape scale forest management, and it can have benefits in terms of affordability and pricing of insurance. And so the modeling can account for it. It's just that currently it doesn't. So that's a area where we need to see the insurers take that up, or if not, we need to see policy change. There's this debate about forward-looking modeling. I think if we go down that road, I think it ought to be tied to underwriting modeling changes that take into account these various things that will help to reduce risk and hopefully keep insurers in the market. So those are some things. And there's maybe a longer list than time allows, but I think fundamentally it's got to, it goes back to, we've got to reduce greenhouse gas emissions. I mean, all these things we've been talking about and more can make a difference in the short run, but we're going to get overwhelmed by more and more of these catastrophic events, and insurers are going to react rationally and say, well, I just can't cover that anymore. So that's fundamentally what we need to do.
Well, Dave, thank you so much. This has been really, really informative. And I am sorry we couldn't get through all the questions, but I think there is so much here that we could probably come back and do this multiple times and not cover all of the issues. So thank you so much for taking time to talk with us today. And thank you everyone who joined us. We will be posting a recording of this on our website in the coming weeks. And so, and you will receive a link to that. Also invite you to stay tuned for future Lunch and Learns. We'll be hosting one next month to talk about some Bay Area resilience hotspots work that the Greenbelt Alliance has been leading. And so we'll be doing that in September. Until then, thank you so much for joining us. Thank you to our partners for making our Lunch and Learn series possible. And we look forward to seeing you all soon. Thank you.